Well, thank you so much for joining Muslim Network TV. This is Malik Mujahid, and I am wondering what is happening with the banking system. More they assure us that our money is safe, more people seems to be nervous, or at least some bankers are nervous. Some people are saying we are investing all together to save this bank, and then bank is sold to somebody else. What in the world is going on? I'm not a banker, but definitely want to learn more about it. Today, the news is Treasury Secretary Yellen says that U.S. is ready to protect smaller banks if necessary. Seems bigger banks were protected because it was necessary, I guess. To discuss all of that, we have with us a professor of law and public finance, Professor Tim Canova. Welcome to Muslim Network TV.
Thank you very much. Nice to be with you.
Well, tell us, whose fault is it?
Well, I think it's a combination of the bankers themselves and the regulators, with the Federal Reserve being very high up on the list. When we take a look at the common problems that the small banks and the regional banks have had, a lot of it deals with is a consequence, I believe, of the Federal Reserve dramatically raising interest rates. And the Fed very much painted itself in a corner after 15 years of a very loose monetary policy and expanding the Fed's balance sheet. It was time for the Fed to start raising interest rates, to start normalizing interest rates. And that requires the Fed to sell an awful lot of bonds, which will decrease the value of the bonds that other banks, that these smaller banks and regional banks have been holding. So that was one of the problems that, for instance, Silicon Valley Bank faced. It had a large portfolio of U.S. Treasury bonds that were purchased when interest rates were low. And as the Fed has raised interest rates, those bonds are worth much less. And I should say that's a problem that the Fed also has. The Fed expanded its balance sheet to something like, I think, $8 or $9 trillion. The Fed has a huge portfolio of Treasury bonds as well as mortgage-backed securities. And as the Fed now raises interest rates, even the Fed's own holdings are worth less. They say that the Fed has about $1.3 trillion in unrealized losses. The only difference is the Fed doesn't have to realize those losses, whereas private commercial banks do eventually.
But holding these bonds, don't you think a whole lot of banks have similar level of losses?
Do. Indeed, I do. And, there was a lot of regulatory encouragement to hold Treasury bonds. They were considered a risk-free asset that would help the bank's capital positions. And I don't think these few banks that have had trouble in the past couple of weeks and failed and been taken over are alone. I think this might be very endemic to the banking system right now. And that's one of the problems that the Fed is facing. Big banks, the banks that are too big to fail, that we now call them SIBs, SIB, systematically important banks. They're sophisticated enough that perhaps they've been hedging their interest rate risk by going into the derivatives market and essentially purchasing interest rate derivatives. But smaller and regional banks maybe have been slow to take care of themselves in this way. They really should have seen it coming, however. And that's one of the problems. Another one of the problems that Silicon Valley Bank and other banks are facing is that their own customers, the loans they've made, have not done so well. Silicon Valley Bank made a lot of loans to startup companies, to high-tech companies, to cryptocurrency companies. And things were looking good for that sector until a year of the Fed aggressively pushing up interest rates, which is going to have the effect of slowing the economy down, particularly for startups, I believe.
So, Professor, what you're saying is that this is a problem which many other banks have because everyone was holding those bonds whose values are gone down. Uh, Person listening to this might be thinking that should I go and get my money out of the bank and put under the pillow or something?
Right. Well, and that's what really happened over the last week or two, where depositors got very panicky and started, you could say, a run on the banks. by withdrawing their deposits. Under the law, the Federal Deposit Insurance Corporation is obligated to insure depositors up to $250,000. So really, for small depositors, there's no reason to hit the panic button that much. However, an awful lot of the deposits, especially at some of these banks like Silicon Valley Bank, were larger depositors because they were business customers. So a business customer is going to quite often have a checking account that's well in excess of $250,000 because they need a lot of money in there to meet their payrolls and other obligations as they come due. What the Fed and the FDIC did last week was really to try to calm depositors, the large depositors, by assuring them that, at least in the case of Signature Bank and Silicon Valley Bank and a couple of others, they would effectively insure large depositors as well. Now, there's a push on Capitol Hill just today. There's talk about lifting the $250,000 cap on insured bank deposits and essentially covering all bank deposits. That's probably a reform that's needed at this point. And the FDIC could do it by simply creating another deposit insurance fund where the premiums are essentially assessed to business borrowers on their accounts. Now, the Fed went even beyond that last week. It opened up a new bank lending facility to try to push money into these small banks and regional banks that are in need. So the Fed is really in kind of this schizophrenic policy position or policy space right now, where on the one hand, they're committed to raising interest rates to try to reduce our inflation rate, to reduce consumer prices that have been rising at about 6% annually now for the past year. And at the same time, they've got to create a new lending facility to pump liquidity into banks that might be having some trouble because of the interest rate increases. So it's really a policy mess, I think, that the Fed got itself into. And, I don't want to put all the blame on the Fed. I think you could go back 15 years ago when we had the big 2008 financial crisis. And the policymakers, in a way, kicked the can down the road. They were content to essentially bail out the large Wall Street banks. They pushed hundreds of billions of dollars of treasury money into the banks in the form of new capital. And at the same time, the Federal Reserve started to purchase mortgage-backed securities in a massive way, over $1 trillion in the first quantitative easing round. And they didn't clean out the banks. When the big banks fail, the managers seem to have no problem keeping their positions, not being fired, not being criminally investigated. And I think it does create a bit of a moral hazard to some degree when the big banks know that no matter what happens, the federal government and the Federal Reserve will be there as a backstop for them.
Is it true? I mean, I remember 2008 when President Obama later on said we made money on the money which we lend to big banks. Was that a true statement that by lending money to large banks, America was able to make money?
While that it was true, you could say in the short run that, and when I say it's true in the short run, Treasury didn't take a loss on the hundreds of billions of dollars that it pushed into the banks in the form of purchasing non-voting warrants, basically stock in these banks. But a lot of the reason Treasury was able to not have a loss and maybe to make a little money was that the Federal Reserve was busy shoveling in trillions of dollars into the banking system and the financial markets. And I'm afraid that just in the last couple of weeks, we see the bill coming due for the Federal Reserve itself.
Now, share with me, Professor Canova, your knowledge. This idea of that your money, $250,000, is federally insured. This time it was said, and it was a very powerful statement, starting Monday, you can get your money if it is there in that bank.
Right.
But are there statutes which require something like this? Or if a large number of failures happen, people are not going to get their 250,000 right away, but in piecemeal fashion. What has been the history of paying back to people?
The FDIC has had a good history of paying back folks on their insured deposits. I think where we get into much murkier waters is if you have a number of big bank failures like we've seen. Signal Bank, and I should say Silicon Valley Bank was the second largest bank failure in American history. If we have a few more of those, maybe the FDIC is going to have some real problems paying off um, insured depositors and even uninsured depositors as well, of course, uninsured depositors. And that would mean the FDIC would have to go back to Congress, and they had to do this in the past. Uh, Both the FDIC and also the Federal Savings and Loan Insurance Corporation, which no longer exists, FSLIC, during the savings and loan crisis. And that would require Congress to appropriate significant sums of money to recapitalize the insurance fund. And it could be hundreds of billions of dollars or close to $1 trillion that would be needed if there was really a systematic bank crisis in this country. So I think that's another one of the reasons why the Fed stepped in very forcefully last week and tried to backstop these regional banks. And we've seen the stock price of First Republic falling. The regional banks have been under a lot of stress as depositors get panicky. They start shifting their funds to the larger banks where they know there's a backstop, because the Dodd-Frank Act of 2010 that was passed in the wake of the financial crisis of 2008, that Dodd-Frank Act essentially enshrines the too big to fail doctrine. They don't call it too big to fail, but they have what are called systematically important banks, SIBs. And those are the big Wall Street banks and other global banks overseas that essentially are being told they are too systematically important. We're not going to let them fail. So you can see that there's an incentive in a bank panic like we've seen, that large depositors might start shifting their funds to those big banks.
Not only is individual and businesses, but our country is blessed with a huge sector of not-for-profit, and they are not big money managers, but they do have a whole lot of money sitting there, and they are quite nervous at this moment. Tell me this. Um, a phenomena. I'm right now coming to you from downtown Chicago. Almost every other store have a sign that they are hiring. Some of them are very generous, announcing that they pay more than $15 per hour or a little higher than that. At the same time, people are being fired, but overall economy is gaining employees, a little less, little more. So when we look around, people have difficulty hiring people, but at the same time, it looks like economy is beginning to crack because of this whole banking system. What is your take on this?
Well, it is true that there are a lot of for help wanted signs. There are a lot of businesses that are looking to hire people at minimum wage or rather low wages that might be having trouble filling those positions. And I think there needs to be more study as to why that is. It might be that during the whole COVID period, people have become more habituated to other endeavors, I suppose. You did put your finger in a way on the problem that the Fed is facing, though, because the Fed is raising these interest rates to try to stem inflation. And the assumption, of course, is that inflation starts rising when the economy is booming too much. Now, it depends who you ask. There's a very big opinion out there, I'd say, among ordinary folks, that this is not such a strong economy. And that conditions for small businesses are still very tight. Credit has become more expensive for small businesses. You got to ask, why are prices rising the way they are right now? Again, the Fed is treating it like it's a boom, that excess demand is pulling up prices. And yet there's a lot of supply side shocks that have occurred in just the last few years. We've seen a breakdown in supply chains from COVID to our sanctions against Russia. These kinds of, and even infrastructure beginning to collapse when you start seeing a string of train derailments and food processing plants that have burned down. So is that a declining infrastructure? Anyway, all of these seem to be supply side shocks where raising interest rates are not going to somehow restore those supply chains. So maybe we're putting too much emphasis on the Fed to fight inflation when other institutions should be waking up to the problems that we have in the supply chain side of the economy. And when I say other institutions, of course, I mean our elected representatives in Congress.
Professor Canova, you being professor of law and public finance, one thing I'm still struggling with. Your thought is that Fed's regulating or and encouraging people, banks to hold more bonds and all that. But Senator Elizabeth Warren and many other people are saying it is actually the deregulation, not the regulation, which is the main cause of these failures.
There's a point that Warren and others have made, which is that in 2018, the Congress deregulated slightly. What they did was the Dodd-Frank Act had required banks that had $50 billion in assets or more to come under increased regulatory scrutiny. And in 2018, they amended that to raise that limit to $250 billion in assets. So some of the smaller and community banks and regional banks then fell into that below the $250 billion in assets, and therefore maybe were not subject to heightened regulation. And that was passed bipartisan by a bipartisan vote of Congress in 2018. Some of this is a political blame game, quite frankly, where the Democrats want to blame the Trump administration for that 2018 measure. And yet the Democrats have been in power for a couple of years and they have not changed that $250 billion limit either. So there's enough finger pointing to go around. However, Silicon Valley Bank, while it might have been below the $250 billion threshold for increased regulatory scrutiny, it wasn't much below it. And it did seem to have the attention of regulators for much of last year. This crisis at Silicon Valley Bank didn't just come out of the blue a few weeks ago. The regulators knew there was a problem, even though it's interesting that KPMG, the auditors, were giving Silicon Valley Bank a clean bill of health, you could say, just a week or two before the crisis hit the markets. But the regulators were aware, and the regulators were trying to push Silicon Valley Bank to raise more capital by the end of 2022. So I'm not so sure if that 2018 deregulatory measure really was all that significant. Whether you had that heightened scrutiny or not, you're going to have this problem in interest rates and in valuations of assets. That's inevitable once the Fed started raising interest rates, which it started doing really almost exactly a year ago. And I believe the last two quarters are the first two quarters ever that the money supply has actually declined. So we're not even talking about a slowdown in the rate of increase in the money supply. We're talking about an actual decline in the money supply. So it's not surprising that many banks might experience and bank customers tighten credit conditions. And of course, the value of the assets being held by banks would be under a lot of stress and losing value.
Well, thank you so much, Professor Tim Canova, who's Professor of Law and Public Finance. Thank you so much for your time.
You're very welcome. My pleasure.
Well, you are watching Muslim Network TV. We'll be right back with other messages.